Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So I remember years ago, I played in a hockey tournament, and one of the teams in our division came down from Montreal. And the rumor was they were really good. I mean, they were from Canada, right? This is hockey. They had to be really good. So we heard rumors. We heard that they scored a lot of goals. We heard their defense was almost impenetrable. Word on the street was these guys were just going to run through this tournament. But when we got on the ice with them, turns out they weren't all that good at all. Pretty average team. In fact, we actually beat them by a couple of goals. So kind of just goes to show that sometimes hype is just that, hype. And I feel that that's true of the economy sometimes. You know, I keep hearing how great everything is. I mean, just look at the stock market. Look at all of the jobs that are being created. And inflation, well, you know, they had that under control until the Iranians made oil more expensive. But it's going to be okay because the war will be over soon and the oil price will go back down and everything will be just fine. And then there's reality. We have a stock market bubble that is juiced by inflation. We have great job reports that keep getting revised downward months later. By the way, the BLS trimmed 16,000 jobs from the February and March data with the latest release. And then we have inflation, and it's not just from an oil shock. In fact, Gallup recently released a poll just a couple of weeks ago revealing that affordability is the biggest financial concern for Americans. In other words, inflation. In total, 65% of the respondents mentioned rising costs in some form as their biggest economic concern. I'll actually link to an article in the show notes page that breaks that polling down, and you can see exactly what people are concerned about. But they're not exactly sanguine about inflation right now. Now, there's no doubt that rising energy costs have put affordability top of mind. So you can understand why you're getting these results in a poll that was taken as gasoline prices were skyrocketing. But, you know, in the first place, you can't just discount that reality, right? It's not like skyrocketing oil prices are less painful because, well, it's just because of the war. You know, I still have to pay that bill. And in the second place, you can't argue that it's only due to oil prices. Monetary inflation is picking up under the surface, and that's going to lead to future price increases, war or no war. In fact, the CPI data released this week makes the "it's only oil prices" argument fall a bit flat. And that's also reflected in the producer prices that came out this morning. Producer prices were up over 1% month on month, and producer prices are often a leading inflation indicator. In other words, we see spikes in producer prices that ultimately get passed on to consumers and will likely push CPI up higher as we move into the future. But interestingly, core producer prices, so stripping out the more volatile energy and food prices, it was still up 0.6% on the month. So that's a hefty increase, even factoring out energy, which goes to show it's not just about oil. So I want to look at the CPI data a little bit. Before we get into that, I do want to thank you so much for listening to the show. I say this every week, but I mean it from the bottom of my heart. I know there's a lot of things vying for your attention. There's plenty of stuff for you to listen to out there. So thank you so much for making the Midweek Memo podcast part of your routine. You can help us grow the show, introduce us to other people. And one way you can do that is just go to wherever you listen to your podcasts and write us a little review. You know, give us those 5 stars. I mean, I'm assuming you think we deserve 5 stars, maybe 4, but probably 5. But yeah, just give us those thumbs up, those stars, write those reviews, share the episodes on your social media networks. That will help grow the show and introduce it to more people, because if you're finding value in it, perhaps other people will as well. But mostly, again, just thank you so much for listening. I really do appreciate it. All right, so looking at the CPI data, you know, no matter how you slice and dice it, it keeps coming up inflation. And the April CPI did nothing to allay fears of renewed inflationary pressure as rising energy prices continued to impact the economy. So if we look at the numbers, on a monthly basis, CPI rose 0.6%. That added to the 0.9% rise we saw in March. That drove the annual CPI, the headline number, to 3.8%, which was the highest level since May of 2023. The monthly increase was basically right on the forecast, and the annual CPI was just above expectations. So if you're watching the headlines, you'll see that they'll tell you that inflation was actually a little hotter than expected. Unsurprisingly, surprising energy costs as the Iran war continues to drag on had a significant impact on the overall CPI. It contributed about 40% to the overall jump in prices. The energy index itself rose 3.8% last month. That was driven by another 5.4% monthly increase in gasoline prices. If you go back to a year ago, gasoline is up 28.4%. So we're really feeling the pain at the pump. But more concerning is the fact that we're starting to see prices ticking up in other categories. Core CPI, which again strips out more volatile food and energy costs, rose 0.4% in April, and that pushed the annual core CPI to 2.8%. Now, 0.4% may not sound like a lot, but it actually is. If you annualize that, you're looking at 4.8% as your core inflation. And, I don't have to tell you that that's way above the mythical 2% target. And again, this is stripping out the energy prices. So these are prices in other categories. And of course, it's important to point out that this core CPI, again, it's still far above the stated 2% target, and it's been mired in this range for like 2 years, right? We've kind of seen it flatline. And so that tells me that the inflation dragon is really alive and well. It also indicates that this recent price inflation isn't merely reflecting an oil shock. Granted, the oil shock is a big part of this, and I think you're starting to see energy prices trickle into other segments of the economy. But, things don't necessarily happen that fast. Some of this increase in prices in other categories is coming from something besides energy prices. And we'll talk about what that is here in just a moment. But, if we break down the data a bit, we find that food prices, I mentioned that already, they rose 0.5% in April. The shelter index, after cooling off a little bit the month before, it was up by 0.6%. Service prices, less energy services, also rose 0.5%. So we're seeing some pretty healthy price increases month on month in categories that aren't necessarily related to the oil price. You also need to remember, and I say this every time that I talk about this CPI, but it's very important. There's so many people out there that just think CPI equals inflation. No, CPI is kind of a thermometer. It's measuring a symptom of inflation. It's not inflation itself. And the CPI understates price inflation by design. Remember, the government revised the formula back in the 90s so that it understates the actual rise in prices. If we use the formula that they used in the 1970s, and you can still find that and do it, CPI is closer to double the official numbers. So if the BLS was using the old formula, we'd be looking at CPI closer to 6 or 7% right now. And if we were using a truly honest formula, it would probably be worse than that. I saw a little blurb today that electricity prices are up 50% in 5 years. So that's like an average of 10% a year? That's pretty incredible when you think about it. And it shows that there are a lot of prices that are increasing much faster than what the CPI data shows. And this comes as no surprise, right? This is a basket of goods that the government has put together. So they choose what goes in the basket. They've created the formulas, right? Shelter's not going out and seeing how much it costs to buy a house or rent a house. They're using this weird formula. So those formulas are subject to human bias, shall we say. So really just want to emphasize that, yes, the CPI is important. It's important mostly because it's what the government number crunchers use, but it's not necessarily an accurate reflection of the true state of inflation in the economy. And again, the CPI doesn't tell the full inflation story, right? It's reflecting this price movement in a basket of good that was made up out of thin air by number crunchers at the BLS. So yes, it definitely gives us some indication of the trajectory of price inflation. However, it tells us little to nothing about the inflationary trajectory as economists have historically defined it. And, I probably talk about this more than I should, but I don't know. It's a thing with me, right? It really annoys me that people conflate price inflation and monetary inflation, and it all gets lumped together. And so it creates this situation where nobody really understands what causes inflation. And it makes them think, oh, well, it's the oil shocks. Yes, oil shocks cause prices to rise. But inflation historically is not rising prices, right? Increasing consumer prices are one symptom of inflation, which was historically economically defined as an increase in the supply of money and credit. Rising consumer prices are a symptom of this monetary inflation. So if you really want to know what inflation is going to do down the road, you need to look at money creation. You need to look at the money supply, because there's only one thing that causes every price to rise in an economy, that raises the entire price level like a rising tide. And that is monetary inflation. It's money printing. So other factors such as oil shocks, they also raise a lot of prices, right? We see that in the current CPI data. However, this is fundamentally different from monetary inflation, which again is only caused by one thing: government central bank money creation. And if we look at the money supply right now, we find that inflation, properly defined, is heating up with or without an oil shock. In fact, if we use the economic definition of inflation as an increase in the money supply, the inflation rate is much higher, double the CPI. So where am I getting that? Well, all you got to do is go to the Federal Reserve's M2 money supply data, and you will find that the money supply has increased from $21.61 trillion in February 2025 to $22.67 trillion in February 2026. That represents a 4.9% increase. In other words, we have an actual inflation rate of nearly 5%. The M2 money supply increased by another $57 billion in March. So this isn't an anomaly. This is what's going on now. In fact, the money supply has been increasing for well over a year, and that pace seems to be accelerating. And we also know that inflationary pressures are increasing because we can look at the Fed's balance sheet, and it is once again expanding. Now, you're never going to hear anybody at the Federal Reserve utter the term quantitative easing. But the fact of the matter is the central bank has relaunched quantitative easing. It did it back in December. So what that means is they are once again buying U.S. Treasuries, using money created out of thin air. And of course, that money gets injected into the economy and increases the money supply. And ultimately, that is inflation. And it will eventually work its way through the economy. It will either manifest in rising asset prices or rising consumer prices or some combination of the two, right? But ultimately, what they're doing is they are devaluing your money by design constantly. So if the U.S. and Iran can negotiate a permanent end to the hostilities going on now, this oil shock will quickly pass. And the pundits and the prognosticators will then claim that inflation is gone. It won't be. As long as the government keeps creating money, the inflation problem will persist. So basically that means forever, which is why you need to save in real money that isn't subject to this government manipulation. And of course, here at Money Metals, we can help with that. Go to moneymetals.com. You can actually check out some of our specials. You'll see the button right on the top of the toolbar. Click that and you'll see all the specials we're running. There's a lot of good deals on silver products right now. In fact, we have silver rounds for as little as $3.49 over spot. We pick the design, you enjoy the savings. So check that out when you get a chance. But yeah, you want to save in real money, right? Because they can't print gold and silver. That's the good news. So, I was thinking about this. The dollar is getting smaller, right? It's getting smaller in the sense that it buys less and less all the time. So, your dollar today is going to be worth, 80 cents in a few years. That's just the nature of the beast. So the dollar is getting smaller, but it's getting smaller in another sense as well, in the sense that the world is starting to spurn the greenback. It is taking a smaller role in the global financial system. Not a lot smaller. It is still, the reserve currency. It is still dominant, but it is, in fact, getting smaller. And I ran across something really interesting the other day. Researchers at Deutsche Bank published a report on de-dollarization, and they came to the conclusion that we might be in the early stages of a fundamental shift in global monetary history. And in the future that they envision, the dollar would play a much smaller role. Now, keep in mind, this isn't something that came out of some libertarian think tank somewhere, or some crazy out of the mainstream conservative think tank or whatever. It was published by an international bank. It doesn't get much more mainstream than that. And when the mainstream starts highlighting stuff I talk about, it really starts to make me nervous because it tells me they can't ignore it anymore, right? So it's probably getting pretty bad. Now, when I talk about de-dollarization, I always get some pushback because I think most people still believe deep in their heart of hearts that the dollar is just too strong and too important to lose its status, right? The dollar is too big to fail, to use modern parlance. They'll say, well, sure, the dollar isn't great, but, it's better than any other currency. What are we going to do? Go to yuan or euros, right? Or you hear people say it's the cleanest dirty shirt in the laundry, which, in terms of fiat currencies, that may be true. And I get the argument. But there is a clean shirt out there, gold, right? There is good money, gold. And a lot of people seem to be turning back to that real money, gold. Just go look at the central bank gold buying data. So as the Soviet Empire crumbled, dude named Francis Fukuyama proclaimed that humanity had reached, quote, the end of history. Now, obviously, that was kind of a play on words, but he was emphasizing the fact that we were at this major turn in world history. And after the fall of the Soviet Union, the U.S. was the unchallenged global hegemon, right? Had unprecedented military and economic power, basically nobody to confront it. Central banks sold gold and accumulated dollars in this environment. The U.S. was it, right? It was the power. It was trustworthy. And things have changed in recent years, right? There has been an undeniable de-dollarization trend. So even before Russia invaded Ukraine, many central banks were starting to accumulate gold. And with the U.S. weaponization of the dollar after the Russian invasion, the de-dollarization pace accelerated. So we have this detailed research report that was published by Deutsche Bank. It was written by analysts. I'm going to try to say their names right, probably going to butcher them. But I think it's Malika Sakdeva and Michael, I think it's Hugh, Hsueh. Hugh? I would assume the S is silent. Anyway, that's their names. And they argued that the end of history has come to an end. So they're playing off of this quote by Fukuyama, and they're saying, we had the end of history. We had this major reorientation of the global system. That has come to an end, and we're about to have another major shift. They wrote, quote, the world is back in a superpower struggle. The U.S. is retreating from free trade, alliances, and security provision. The great economic modernization is behind us, and the dollar banking system has been weaponized. The return of history has big implications for gold and the dollar. So what are they talking about when they mentioned the great economic modernization? Well, they were talking about the 90s when the U.S. was kind of had that peace dividend. They were drastically increasing military spending or decreasing military spending. The Clinton administration actually ran a couple of budget surpluses back in the 90s. The dollar seemed strong. There was a push towards free trade. everything was coming up roses at that point, right? Well, now we're not there anymore. And again, big implications for gold and the dollar. But here's a fair question. Is de-dollarization even really a thing? Some people think that it's not, or that it's being overhyped. And, when somebody like me is talking about it, somebody that's not really in the mainstream, I guess you can make that overhype argument. Maybe I'm just trying to make a point because I hate America or whatever. But when Deutsche Bank starts talking about it, maybe there's something to it, right? And the data is hard to ignore. The share of dollars in global central bank reserves has dropped sharply from around 60% to around 40% today, so a 20% decline. Meanwhile, the share of gold has doubled in the last 4 years to around 30% of total global reserves. As our Deutsche Bank analysts note, quote, before the 1990s, gold had consistently been a larger share of central bank reserves than the fiat dollar. But by the end of the 1990s, the dollar was over 4 times the share of gold. This seems to now be going in reverse, with gold clawing back its share rapidly. What happened in the 1990s, and why is this unwinding today? How far can it go, and to what end? Now, your de-dollarization skeptics, and they're out there, they will counter that the rapid rise in the share of gold reserves is purely a function of rising gold prices. So in other words, it's not that central banks are buying up a bunch of gold. It's just that the gold that they already have is going up in value. So therefore, the dollar share of gold as your reserves is going up. But Sakdeva and Hugh argue that the rise in the gold price is at least partly a function of central bank gold buying. Quote, there is a genuine volume driver underlying this. Central bank purchases have arguably themselves been behind significant price momentum. There is indeed a close relationship between official purchases and sales of gold and the change in the real gold price. Volume and prices are related and are both doing the legwork of gold's rising share. In other words, central banks are buying more gold. That is pushing up the price, which is raising the value of gold reserves. So these two things are actually working in tandem. And so another point that the Deutsche Bank analysts make is that a lot of this, or virtually all of this central bank gold buying is coming from emerging markets. Since 2008, emerging market central banks have gobbled up 225 million ounces of gold. Sakdeva and Hugh argue that the trend, that they expect the trend to continue, noting that even with the recent pace of purchases, emerging market central banks still hold half the amount of gold as developed market banks. In other words, they have a long way to go to catch up. Sakdeva and Hugh believe that the decline of gold and the rise of the dollar wasn't solely due to the end of Bretton Woods, and they think that it was driven more by geopolitical shifts. They say it was not a transition in the monetary system, which had occurred 2 decades prior, but a shift in the geopolitical environment that changed the role of gold. And that's an interesting take. I'd never really thought of that because we tend to think of that end of Bretton Woods as kind of the end of a strong dollar because Nixon severed the last link between the dollar and gold. But Sakdeva and Hugh are arguing that that really wasn't when the global order really shifted. It really shifted in the 90s, right? So with the USSR gone, the US was not only the biggest kid on the block, it was virtually the only kid in the neighborhood with any muscle at all, right? Our Deutsche Bank analysts write, the U.S. thus became an uncontested hegemon in what appeared to be a geopolitically unipolar world. Japan, which had been the U.S.'s closest economic competitor, was well within the U.S. security and dollar system, and China was still a decade from joining the WTO. So America was number one. And so the dollar was strong. So these emerging markets are like, well, we don't need gold. We'll just get this dollar because the dollar is it. And of course, since then, that has changed, In that environment, everybody wanted dollars. EM central bank dollar reserves went parabolic around 2000. Quote, in sum, the biggest driver of gold's decline in global reserves in the 1990s was the rise of EMFX reserves accumulated in dollars. This was in turn a function of dramatic globalization in a U.S.-driven neoliberal unipolar order amidst sound and improving economic fundamentals in the U.S. So everything was great in the 90s and into 2000. Of course, things have changed. Many countries are now wary of holding dollars. They don't want to be subject to U.S. foreign policy bullying, and they are concerned about America's fiscal malfeasance, that $39+ trillion in debt, and a borrowing and spending problem that nobody seems interested in solving. The 2008 financial crisis was kind of a canary in a coal mine, right? Aggressive sanctioning of Russia after it invaded Ukraine may have been the final straw that broke the camel's back. Sakdeva and Hugh point out that several trend reversal from the 90s that seem to be driving de-dollarization. Number one, the U.S. is stepping back from free trade and fracturing traditional alliances. We've had the tariff regimes and those types of things. Number two, the relationship between the U.S. and emerging markets is reversing. In the past, the U.S. outsourced manufacturing while emerging market countries outsourced security and savings. Today, the U.S. is onshoring more critical manufacturing, while many EM regions like Asia and the Gulf will be reconsidering their need for strategic autonomy in areas like energy and defense. Number three, the U.S. has lost control of its inflation dragon. And four, we have the weaponization of the dollar that we've already talked about. Quote, the end of history has itself come to an end with significant implications for gold and the dollar, which are becoming increasingly apparent. So that's a fancy way of saying that if de-dollarization and emerging market gold accumulation continue, it could drive the gold price even higher. According to Sakdeva and Hugh, for every 1 million ounces of gold purchased by central banks, the price rises by 1%. So our analysts ran 4 different scenarios with varying levels of de-dollarization and central bank gold buying. And running these models, they determined that, quote, even in an environment where EM FX reserves declined to $5 trillion, so we're talking about total emerging market reserves, they dropped to $5 trillion. Gold prices could still rise to $8,000 an ounce over the next 5 years if EM countries all target a 40% gold share. And we're not even anywhere near that, right? So we're not talking about a complete de-dollarization here. We're not talking about a collapse of the dollar. We're simply talking about these central banks raising their gold reserves to 40% and declining their dollar reserves in a similar manner. And when you boil it all down, this could signal a fundamental shift in the global monetary order. And this is kind of how our analysts sum it up. Quote, in sum, while emerging market central bank diversification into gold likely has much to do with preserving the value and accessibility of their foreign savings in a changing geopolitical climate, it may also, in the long run, play a role in anchoring a monetary order that builds independence from the dollar. There is, of course, a very long way to go. EM central banks as a whole still only hold half the physical gold of advanced economy central banks. But there is a world where gold returns to the center of a future monetary system with different leaders. That's pretty chilling if you're an American, because as I've mentioned over and over again on this show, even a modest de-dollarization is a big problem for the U.S. economy, right? Because the U.S. depends on global demand for dollars to maintain its borrowing and spending in its massive size. So kind of breaking it down, since the global financial system runs on dollars, the world needs a lot of them. And that's good news for the U.S. because the United States depends on this global demand to underpin its bloated government. The only reason that the U.S. can borrow and spend and run massive budget deficits to the extent that it does without cratering the bond market, driving interest rates through the roof and creating hyperinflation is due to the dollar's role as the world reserve currency. This creates a built-in global demand for dollars and dollar-denominated assets. This absorbs the Federal Reserve's money creation and helps maintain dollar strength despite the Federal Reserve's inflationary policies. Think about that. Imagine if during the pandemic, the U.S. had injected $5 trillion nearly into the financial system, all of this new money. Imagine what would happen if the world didn't want any of those dollars, right? So that's what I'm saying. The world absorbs those dollars, and it creates an environment where the U.S. can inflate much more than it otherwise could. So what happens if the demand stops, right? What happens if the BRICS nations and other countries don't need as many dollars? It would lead to a dollar glut, right? The value of the U.S. currency would depreciate even farther. At the extreme, global de-dollarization could spark a currency crisis in the U.S. You and I would feel the impact through more price inflation, eating away at the purchasing power of your dollar. And in the worst case scenario, it could lead to hyperinflation. I know most people think, oh, well, we couldn't ever have hyperinflation in the U.S. Well, never say couldn't, because we could. It's absolutely possible, especially in a scenario where the world is spurning the dollar. Now, I don't think it's going to get to that point. I think there's going to be a strong demand for dollars moving forward, but even a modest de-dollarization is a problem for all the reasons that we've already discussed. Because as the world needs less dollars, more of those dollars are going to come home. It's going to increase inflationary pressure. It's going to make it harder for the U.S. to continue to borrow and spend. It's going to drive interest rates higher. All of these things that we see happening in the economy today. And this is why I emphasize over and over that you want to have real money, right? You want to have money that holds its value over time. De-dollarization is happening, right? Inflation is a matter of policy, so currency depreciation is going to continue. Your purchasing power is going to decline. If you are saving in fiat dollars, you're going to have less to spend in 5-10 years than you have today by a significant amount. Again, even if it's just by the plan, you're looking at a 10% devaluation of your dollar every 5 years. So this is significant. You want real money. So that's why this is a great time to call 800-800-1865. Talk to a money metals, precious metals specialist. Both gold and silver have been basically trading sideways, although we've seen silver break out a bit in the last week or so. But I think in general, we're going to continue to see this sideways trading, at least until we get some kind of resolution from the war. But I think it's a buying opportunity. We've talked about the fact that there's plenty of momentum left in this bull market, and especially in the silver market. I'll link to an article in the show notes that talks about why silver has gone up as quickly as it has and why there is still potential for more upside. So I'll link to that as well. But call 800-800-1865. Talk to a precious metal specialist. If you don't want to talk on the phone, you can go to moneymetals.com, just chat online. Or if you know what you want, you want to get some of those specials, you can click the special tab. You can order right online. We'll ship your metal straight to you. Or if you prefer, you can store your precious metals in our state-of-the-art bullion depository in beautiful Eagle, Idaho. But act today, right? You can't get your fire insurance when your house is burning down. And I think we're getting closer and closer to that conflagration. So with that, we're going to call it a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast that runs every single Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Again, thank you so much for listening to the show. I really appreciate it. I hope you have a fantastic rest of your week, and I will be back again with you next Wednesday.